Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Booking Holdings, ticker BKNG. This stock has a crazy valuation. I'm coming up with a fair value of $4,420, currently trading for $3,834, discounted cash flows of $5,096. Very strong cash flows with this. So we're going to hop right into the numbers over here. Earnings yield 4.23%. That is pretty good. We'd like to see them come in with an EPS of about 192 for what we're paying. And they're going to be coming in with north of that this following year, according to analysts. 198.96 next year, 174.9 this year. Cash flow yield, very strong cash flows recently, 72.76%, on average 22.24, which is in and of itself very strong as well. The balance sheet is something here that I don't like, though. ROE is negative 156.3. Debt to equity is negative 9.87. If we really look at the balance sheet, we see that they have total assets of 24.34, but total liabilities of 27.1, and their net tangible assets are actually negative here, which is very strange. Balance sheet is not in very good shape here. ROI 7.3, ROA 17.62. So those two are really good. It's just that equity in their balance sheet that is concerning. I wasn't able to pull all the data to calculate the gross margin, but the net margin, they came in at 20%, which is really good. Typically, they're around 12.4, which in and of itself is pretty good as well. Revenue growth, very strong, slowing down. Looks like these last 2 years, it's been 25% compounding. The analysts are only expecting 7.6 this year and 7.7 next year. So decent numbers, but still a pretty big slowdown. They buy back shares, clearly. There's not a whole lot that exist. And in the last 2 years, they bought back 5.74, 9.15 in the last year. So we're going to go with 7 for our thesis there. Buying back 7% of the outstanding shares. It might even be more than that. We'll have to see how things play out. But that's a pretty conservative estimate. Cash flows, they have done a really good job at growing. They were negative in 2020, but we see that there was a big jump to the positive, and it's just trending upwards. So we're going to continue with that. I'd say 5% annual growth in the cash flows. Assets, small growth, if any. Usually they're actually selling off their assets, so negative 2% for that. Liabilities are growing very fast. 15.76, 19.96, 17 to 18% would be within the range of what we've seen out of them. Assume no dividend growth or margin growth because those are already at decent spots. And what we end up with is an annual growth rate with the dividend factored in of 4.33%, which is underperforming the market. And almost all of that is coming off of this balance sheet and how they're selling off assets and growing their liabilities, just losing value on a really important portion of the business. Revenue growth is decent. Share count growth is really good as well. But the damage is being done on that balance sheet. Now, let's say that they can turn things around. We see 1% growth in those assets and liabilities. I can only be fair and say 15% growth there. Things got a little bit better. The problem here is the current state of the balance sheet and how they're dealing with it. So if you're buying at today's prices, in 3 years, you're looking at sitting on 20% growth from the current share price, at least in the fair value, which underperforms the market by 6%. And in the next 5 years, you're underperforming the market by 8% with 39% growth. If they can stop with the liabilities, if they shrink their liabilities in the slightest, then we're looking at returns in line with the market in the next 3 years and slight outperformance in the next 5 years. So at the end of the day with this one, it's a personal preference thing. Cash flows are strong, earnings are strong, but the balance sheet does not look good. If you think that they're going to be improving on that, then it's definitely worth purchasing at today's prices. And if you don't, and you think that they're going to continue on the trend that they have, you can wait for a bit more of a dip. I mean, it's at 3,800. It's gone as low as 2,700 in the last 52 weeks. So There's been a chance. There's a potential that there will be another one. Just to look at the trends on this balance sheet, we see here it's really flat on those assets, and the tangible assets have just been on the decline. And then liabilities have been growing and growing and growing, with the tangible book value on the decline. This is the number that we care about the most, and it's not trending in the proper direction. And I don't know that there's much more to say about this one. The balance sheet is in such bad shape, it's giving a negative valuation to the company. Dividend, now that they started paying one, is lagging behind everything else. I feel like they could definitely afford a bigger dividend, but they just initiated it this year, so we'll see how things play out. Fair value does have a nice linear trend here. The actual share price moves pretty well in line with the fair value, at least as of 2022 forward. There was a bit of a discrepancy back in 2021 where it was much higher, and it pulled back right to about the fair value. Earnings moving very closely with the fair value of the stock. It seems to be tied to earnings quite a bit. And cash flows seem to be leveling out a little bit. They had some nice linear growth, and it's just smoothing out up there, with earnings taking over come next year's projections. And I'm not sure that there's a lot more to say about this one. I mean, we can change some of these numbers here. Let's say 8%, slight outperformance in revenue growth. They buy back 8% as well. Cash flow growth, the yield's what's important here. 22 average, 32 this year. I think that 28 in 5 years is very fair. Assets, we said make that positive. Liabilities, we said negative. Let's say they continue to grow this dividend rather quickly. Even 10% growth gives you a yield on cost in 5 years of 1.5%. So that's fair. And margins, 20% is a very strong margin. I wouldn't really mess with that. In this case, this would be our more bullish scenario. You're outperforming by 4% in the next 3 years and 14% in the next 5 years, with average annual returns of 7.5%, in line with the markets. After you factor in the dividend, 7.4%. So this case gets you market returns. Not market beating, but you're getting in at a fair value low enough that it makes up for it. So if you believe in the management and turnaround of the balance sheet, this is a turnaround play. And you have the potential to make market returns off of it. So that's a bit of a risk, especially for such an expensive company. But I don't think that I've given enough credit to cash flows when I've looked at companies, because it does give them a lot of opportunities to fix balance sheets or make acquisitions or just large investments into the future of the company, and things compound that way. So I'm looking into giving a greater weighting to stocks with good cash flow yield. But that's all for this one. I don't really see a worst case scenario. I feel like the worst case scenario is really the reasonable scenario, because they've had some strong growth over the last few years, and something would really have to change for stuff to plummet. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.